All right, everyone, welcome. We're so delighted to be here with our Century 21 friends. I am Samantha Tunador, and I'm joined with my husband and business partner, Ton, and we want to walk you through the basics. We are recording this, so you're welcome to share it afterwards, revisit it, or share it afterwards. And we're going to follow right into at 11:30 an advanced mortgage information. You might find you want to stay on. You're welcome to, or more people will be joining us through the call. So I appreciate you all and thank you for taking time out of your day. We'll walk through this pretty quickly with a little bit of back and forth and make time for questions for you, but please feel free to use the chat also.
And I'm fine with people jumping in. If you want to unmute yourself and ask questions or going through, please feel free to do so. There's not a ton of us on here right now, so I think it's manageable. Samantha, do you want to start?
Yeah, go ahead. You want to next screen?
Sure. So this first half hour is going to be kind of just a basic overview of mortgage cycle, looking at pre-quals versus pre-approvals, underwriting, talking about different employment, contract, which is real important to all of us. Talk about ACM, of course. We've got to plug ourselves a little bit. And then when the contract's ratified, what to do. This is a class that I think probably most of you know Thad. He put this together a while ago. It's been revamped, and it's real similar to a CE class that I've got in Virginia, which really, I like, instead of calling it mortgage basics, I like saying it's realtor-lender relations and how can we all work together? Because obviously we're all here for the same goal, which is to help our clients get a house. So we're going to do a quick run through of the process right now. So the mortgage life cycle, this is a cutesy monopoly, or what do you call it, Samantha?
Monopoly.
Loanopoly, going through the steps. And we do have this as a marketing piece that can be co-branded. If you see on the left here, I think this one has Amy on it. It's a nice little flyer if you have a buyer presentation to give to them up front, so they kind of get an idea as the timeline. So not to get down in the weeds with all of this, but really it gets them through pre-approval, obviously finding a house, making an offer, applying, and then what happens next. We order the appraisal, go to processing, underwriting, commitment, et cetera, et cetera. So this is just a nice, quick outline of the process, giving the clients an idea of what to expect. And I love the avoid these common mistakes. I can't highlight on here. I love these avoid these common mistakes, which is the don't change jobs without letting anyone know, don't make any large purchases, etc. We do have emails that go out. If any of you have had loans recently with us, we've got emails along the way to both. Some of them are directed just to the buyer. Some of them are going to go to you as well as to what stage we are in the process. And the ones that I get the most feedback from are the, avoid these common mistakes email, which I forget the header of the email. It doesn't say mistakes, but it talks about, let us know. And I love the fact that many of the buyers reach out with, hey, I'm going to charge, $3,000 for patio furniture. Can I do this now? And for most buyers, it's, yeah, no big deal. Go for it. But for some buyers, it makes a difference. So it's really good to keep tabs of this. So this is just a nice cheat sheet of the process.
I think it's key with your clients to set the proper expectations, and we're here to do that with you. If we let them know what to expect and then we deliver and over deliver, you have a delighted client in the end. So from the ACM team, we really walk them through from the very beginning. When you first introduce us, we let them know what's happening, what's going to happen, and we keep reminding them. So it's a combination of mail and conversation and emails so that they feel very educated about the price process, which does help for better decision making and a more delighted client in the end. So that's kind of our ultimate goal, is to be able to partner with you. And if you've noticed on the bottom left, you can text me for this marketing material or others. I can throw them together pretty easily, co-branded with you.
And just to point out a couple of the blocks or the squares on here, obviously pre-approval upfront, super important. Finding a home is your big focus, of course. But what I really like to stress, and I stress this with buyers all the time, is when you're looking at houses, don't hesitate to send me an address. because it's way better for them to write an offer on a property or to even look at properties when they're really clear about what it's going to cost them. So I will do numbers all day long with specific properties for clients. I've got someone right now that's still looking for the last couple months, and I think I'm over 40 different houses that I've given them numbers for. And I know some of my peers, let's say in the industry, cringe at that, but we've got great programs, great software to do it. It's quick and easy. We have access to Bright, so I can pull the numbers quickly. So please, the same thing, encourage them to communicate. And if they're looking at something, if they're considering something, reach out. I'm going to pop ahead here. So mortgage introductions. This is another one that I think is real important to all of us because it's real easy to meet that person, push them, whether it's our way or you meet them somewhere and then kind of lose track of them. So we really, really stress that it's super important to introduce them to your preferred lender. Hopefully it's us up front.
If you, can I interject? Sorry. If you say, I've got a lender and hand them a card, they're pretty unlikely to reach out to us. It is in a way better to add value of, would you like to see what the numbers look like on a house like this and how it applies to you? I'm like, yeah, I do. Or I've got a team. I've got someone who can help you with this. Can I make an email introduction?
Yeah, definitely, because people don't care about the numbers for the most part. Most people don't. They care about the house and the whatever it might be, the shiny kitchen, whatever it is. They don't care so much about the mortgage. That's the afterthought, Sunday evening at 5 o'clock after they've seen it at an open house. So introductions up front are super important. I would ask whoever you work with how they work, how they operate. So if it's us, email introductions are great. Those of you that have worked with us know I love my bomb videos. It gives them a little bit of a warm, fuzzy feeling that there's a person behind the loan application link. So that's the big thing. This is another, Samantha, this PDF is what, a house hunting checklist. This isn't mortgage related, but it's something else that we have. So we have a ton of materials that can be co-branded if you want things to add to your packages.
And I think it's just key when the first part of the conversation comes up is you want to get them connected with a lender ASAP. It's not later, it's ASAP to save not only you time, but them time. So we're always happy to put those together. Go ahead. Oh, you know what? Tell me, go back a screen. I'm sorry. Obviously getting to know us. I mean, we're really lucky with Century 21 and getting to be in the offices, but we do want to connect with you. Don't ever hesitate to reach out to get to know us better. We know it's a know, like, and trust system also. And I have a note there with lead with one introduction. I was talking to a new home sales agent yesterday, and he was going to work with a new builder. And he said, oh my gosh, they have 6 lenders on their list. They're going to hate it when I come in there with just one. And I'm like, no, a consumer, if you give them 6, 3, 4, 5, 6 names, it's overwhelming, especially if they reach out to each and then they get different responses and different times back, and they're playing phone tag and they're getting a bunch of different information. An overwhelmed mind will say no. So we want you to feel so confident that you can say, I've got a team. I've got the people that you need to talk to, and I have backups if needed. And we're certainly there to help you too. Like if we can't do a land deal, we've got a person. If you need someone who speaks Spanish, we've got a person. So we're here to help you and your client shop the very best rate and program for them. And we know from experience, we hear from experience that if you lead with one introduction, it's going to be of higher service to your clients. Lead with a person you would use to do your own loan.
So getting more into the loan stuff. So this is a question for my CE class I always ask, and I think everybody on this call probably knows the answer. What's the slide says which is stronger, a pre-qual or a pre-approval, but the better question is what's the difference between a pre-qual or a pre-approval? You're going to hear the terms used interchangeably in the industry. There is not a true definition for either one because some companies will call a pre-qual a pre-approval or vice versa. Typically, a pre-qualification is simply whatever information the client stated or even input on the loan application. And quite frankly, it means nothing. So if you've got a client that comes in with a loan letter from abc.com mortgage, And, first thing you want to ask them is, did they actually apply? That's good. But did they deliver documents, et cetera, to the lender? Because based on just stated income, stated assets, et cetera, it means absolutely nothing. So typically, if you see the words pre-qualification or you hear that, it doesn't mean anything. I think most everybody on the call knows this. Pre-approval means that there has been substantial information gathered from the borrower, from the buyer. And in the ACM world, we deal only with pre-approvals. I'm asked not super frequently, but frequently enough, well, the other lender didn't ask me for my pay stubs or my bank statements, etc. They gave me a pre-qual letter, or they told me I was pre-qualified at this. Even if it's a phone conversation and the client says, I just want to have an idea of what I qualify for. I cannot tell them what they qualify for based on a phone conversation. No lender can, because there are always going to be things out there. Big one is credit, if we don't have a credit report. But when it comes to documentation, this sounds funny, but a lot of people really don't know how much they make from a lender standpoint. It could be commission income, it could be overtime, it could be varying hours, that sort of thing, unless it's a straight government salaried job. So what you want to do is, in my opinion, forget the pre-qual word. Don't even use it. Talk pre-approvals. Tell them, let's get you pre-approved, not let's get you pre-qualified. Let's get you pre-approved. Let us, your lender, whoever it is, take it from there. And I prep them up front that, hey, it's pretty easy, quick and easy process. We can typically turn them around same day, next day. We do need an application. It'll take about 15 to 20 minutes of your time. It's pretty straightforward. If you have questions while you're filling it out, just give me a call. And then we do need to collect income and asset documents. And then based on what we've talked about for each client, I'll let them know, well, that's pretty straightforward. We'll need 30 days pay stubs, 2 years W-2s, 2 months bank or asset statements. So I always tell people it's two. Think of twos. We need 2 years bank statements, 2 pay stubs or 30 days pay stubs, 2 months asset or bank statements for any funds you're going to use for the purchase. And then depending on if they are self-employed or if they own investment properties, we may or may not need tax returns. So like I said, pre-qual, I'd say forget it. Just be aware of it. If you get a pre-approval letter from someone that says pre-qualified or pre-qualification, it probably doesn't mean anything. You need to ask more questions to the lender. Pre-approval is ideal. And then a TBD underwrite. So this is going to be the strongest of the group. This is where we actually submit the file with a to be determined address. So pre-contract to underwriting. We can do this. This is not going to be a same day or possibly even next day process. So this is something that, like, our team, we use this when we have what might be, I don't want to say a shaky loan, but it's not really straightforward and we can't confidently tell them up front, you're going to get a mortgage. We might submit it. I had one this week that had 1099G income. I don't know if anybody knows what 1099G income is. My partner Lori and I were both like, what's a 1099G? It's a government grant. She has a fellowship with NIH, and her 1099 income, which is typically self-employed, on her tax returns, it's not listed as self-employed income, it's listed as grant and actually prizes and awards income, and it's not usable for any loan program. So that's a situation where we sent it to underwriting. We did get it was same day review of the income documents, but this is where they would get an actual underwrite, actual credit decision. So this can be great for self-employed borrowers if the income is tricky, first-time buyers if they're having a hard time getting in this crazy competitive marketplace. Ask about it. ACM calls it our Approval Plus program, where we actually send it. If you have somebody you're working with that you think may need this, or if you think they're going to need it just to compete with contracts, reach out, ask about the time frame, ask about the process, and let's get it started early. So that's a biggie right there.
They're going to start with an app on their phone or from the computer to do this process. And as Tom said, it's only 15 minutes. Century 21 chooses to work with ACM because we're a local direct lender and we have the underwriters in-house, which when they're talking about going with a big bank or an online, you're not going to have the close connectivity that you have with ACM, which is, Century 21 knows it's in your best interest to have the local bank and hopefully you see that and are able to pass that trust on along also to your clients.
And the big takeaway from all this is, and I think everybody knows the answer to this question, but when should they apply? They should apply yesterday. I know it's easier said than done, but you probably don't want to take someone looking at houses if they don't have a pre-approval. I saw it in my real estate days, which I know most of you on the call. I mean, I was a realtor for 20 plus years, broker, did the whole range, and I broke this commandment many times. I know I shouldn't have, and I got burnt by it. As if you haven't yet, you will at some point probably. But you don't want to start showing people houses at 800,000 to find out that they qualify at 600, or they don't have the cash to close, or they don't have the credit to close. So getting them approved up front, huge. I know it's easier said than done, especially if you're sitting at open house on a Sunday. That's where we have our fire drill applications Saturday and Sunday afternoon, which we're always happy to do, but we'd rather prevent it so that it makes it less stressful for you, us, and the buyer. So that's one thing, is just push people to apply. So what is underwriting? We're going to look at what the 4 C's are. How long does it typically take? What's a conditional commitment letter? We get asked all the time for what we need the commitment letter. We'll talk about that, and what kind of issues, delays might we have. So the 4 C's of underwriting, what's evaluated, and this is kind of just really breaking it down. One, their capacity. This is underwriter, and we do this up front with a pre-approval, of course, reviewing their income, employment history, monthly debt payments to make sure they have the means to afford a mortgage, and what type of mortgage. It's going to be slightly different product to product, mortgage to mortgage. So, and we'll talk a little more about that in the next class, about the different types. But this is a biggie that is kind of like encompassing what an underwriter looks at. They're looking at their capacity, their capital, straightforward. What funds can they use? With regular FHA, VA, conventional Fannie Freddie loans, pretty straightforward. We're looking at funds to close, down payment, closing costs. When we start getting into the jumbo or non-conforming world, it gets a little trickier then, because then you'll note here it says document funds due at closing and reserves if required. So reserves means savings, and typically with the regular run-of-the-mill loan programs, FHA, VA, Fannie, Freddie, conventionals, even USDAs, we don't have to typically worry about reserves or savings. But anytime we get outside of the normal box and look at jumbos, non-conforming, we have to worry about reserves, and that can be crazy. I'm trying to think when it wasn't last year, it was probably the year before. I had first-time buyers buying a condominium in Old Town Alexandria for $2.5 million. Crazy. And because they were first-time buyers, because it was a super high dollar loan amount, they were doing 20% down, so it was a really high loan. The reserves requirement was 24 months of the principal and interest, the payment, and HOA or condo dues. So it was a huge number that the buyer doesn't think about it. The example I would use all the time would be, somebody sells their townhouse in Fairfax and they have $200,000 equity, and they're like, oh, I have $200,000 equity, I'm going to go buy $1 million house in Loudoun. And they think they've got their $200,000. They aren't thinking about the closing costs, and they aren't thinking about potentially any savings or reserves that are required.
No longer 20% down.
Yeah, well, it's 20% down, but it's 20% down, plus we have to document additional funds. Collateral, the value of the subject property, and this is what the appraisal for, and everybody's familiar with what an appraisal is. This is pretty straightforward. We have to, for most loan programs, for most scenarios, we have to get an appraisal. I guess I could jump into appraisal waivers quickly while we're here. Is everybody familiar, or I'm sure everybody's heard of an appraisal waiver, correct? Just really quickie on that one. If it's a Fannie Mae or Freddie Mac conforming conventional loan, meaning it's a conventional non-government loan that conforms to Fannie Mae, Freddie Mac guidelines, if the sales price is less than $1 million, if the down payment is at least 20%, there's the potential of an appraisal waiver where we do not need an appraisal at all. And the $1 million sales price limit was put into place fairly recently. This is something that when I have buyers that fit that box, that they're doing 20% or more down, and they're competing obviously with contracts, this is when it's really important to make sure that we or the lender has the property address, the offer price so that we can run the automated underwriting service specific to that address, specific to that loan scenario, specific to that borrower to see if an appraisal is needed or not. I have clients that wrote on something in Blacksburg yesterday, still waiting to see what happens with the contract. We didn't get a full appraisal waiver. We got a value acceptance waiver from Freddie Mac, meaning that the value that they're offering on the property, which was $415, is fine with their 25% down, but an appraiser is still going to have to go to the property. And I joked with the agents and said the appraiser has to go out there to make sure the house exists. And that's kind of joking, but kind of the truth. They need to go out there and make sure that it exists, that it's in decent condition, but there won't be any question of value. The value is fine at the offer price. And credit, of course, is really important. And this is a real good reason to push people to apply early. We all know a lot of clients are afraid of getting their credit pulled. I can typically talk them off that ledge. But we do need credit scores. We do need that's going to dictate the type of loan, the down payment, whether they qualify or not. And frequently we can use that as a tool to help plan. Who was yesterday I talked to that was afraid of getting their credit pulled, and when we deeper conversation, she said, well, when I last checked Credit Karma, it was 791. I was like, hey, you're fine. A mortgage pull is not a derogatory. It's not going to ding your credit. It's not a permanent mark. It's nothing bad. It might affect your score in the short term, 2 to 5 points maybe. But if someone's sitting in the 790s, it's not a big deal. If they say, well, my credit's 680 and not 790, that's sometimes all the more reason to go ahead and apply early, get your credit pulled, so we can look at, are there any quick fixes we can get to move the credit score up?